Hello, everyone. David Moore here, and I'm blessed to have my brother Tom with me today. You guys get tired of hearing me. We want to bring Tom in and get some real good information from him. So it's a day mid-September of 2024 for future context. It's sort of an entertaining time in that we don't really know what's going to happen with tax laws going forward. But you've heard my story of how the firm got started, and I'd sort of like to have you hear a little bit about the company from my brother Tom's perspective and what sort of makes us unique in the industry.
Yeah. Well, good morning. The whole impetus behind our starting this company was really that we weren't able to get the kind of help that we wanted with respect to 1031 transactions when we were doing them. And we really wanted to offer a service that did provide a lot of information and be able to consult with people and give them answers and solutions to their issues and problems going forward. Just yesterday, we had most of our staff in a meeting that went probably a couple of hours long, and we were discussing a couple of transactions where even though we spent a lot of time with our clients, their plans had changed midstream and they did not notify us, and that kind of thing results in problems. So, we have always tried to be there for our clients and have live, warm voices on the phone when you call in and be able to have somebody available to talk to you always, and you're not getting answering machines and voicemails and stuff like that. And I think we've got a lot of people that have come back to us year after year after year for 30 years now, 30 plus years, and I think that they really appreciate that.
So one of those things, it's just conversations, and that transaction, part of the issue was that the client didn't really want to take the time to even talk to us, right? I mean, to
Yeah.
explain what we wanted to go through the deal with them, and just couldn't even get them to talk to us on the phone, correct?
Yeah, exactly. And this stuff is super important for the client to understand. And I know they had tax and legal people involved as well, but the client themselves needs to be fully aware of how important all these deadlines are in the transaction, and just exactly what they can and cannot do. And they obviously they work very hard to make their money, and as we always state in our ads, we work very hard to keep their money theirs, and it has to be a team effort. So yeah, conversations are super important.
So I think, I mean, one of the things we're up against right now, even with the inflation and everything else, everything's been sort of mushroomed. The interest rates are higher, but you've got people that have properties maybe have gone down in value. They might have situations where going forward, they might have to inject money into a transaction, a variety of different things that need to happen. And this code is over 100 years old at this point, and you'd think there'd be better level of knowledge across the tax and legal community, and it just doesn't seem there. And I think, if you think back when we put the company together, I mean, we put it together because really nobody was here doing it. And since then, you've got big national companies that have gotten involved, and it just seems as though they just handle it as a transaction and sort of order takers. But I mean, we've had a few deals recently where something's been set up with brand A that just is an order taker, and then somebody gets us involved, hopefully before it closes, and it ends up being restructured. I mean,
Yeah.
fairly common occurrence, unfortunately. Or, I mean, how often, Tom, do you take a call or working with somebody that is actually working with another company but unable to get answers?
Pretty common. Not just me, all of our advisors in here will take phone calls, and they've got people who are working with other companies, and they're just not able to get a hold of them, or they're not able to get answers and get the help that they really need. A lot of their tax and legal people are telling them to ask us the questions, ask the facilitator, accommodator the questions. So it again is really important that they've got somebody there to speak to the client and get some answers.
A lot of people don't want to talk, right? I mean, they just want to email or text you and say, hey, put it together. But you don't know what is necessary, or what we want to know, why you're doing the deal, and the opportunity cost of the transaction is. you got to get it done in that 180-day timeline. You got 45 days to figure it out. And that's part of the problem with that transaction yesterday. That was a problem, right? And it's really communication and understanding that if you choose to do this, one, we don't want to do a deal to do a deal. We want to make sure it's getting you where you want to go. And the opportunity cost of the transaction is that finite period of time.
Yeah, and we fully understand that plans change, and it's just the nature of real estate that somebody finds something. Initially, it looks like a great acquisition. It's going to fit their needs, and then as they go through inspections and all the due diligence process, it's not working out for them. And so, yeah, we certainly understand with real estate that plans change midstream, and we're not saying you can't change plans. Just let us know. And if not working with a company that does have the staffing that can take the calls and answer questions, and if you just don't have that communication, that's where trouble arises.
So in the marketplace today, I mean, obviously, if we look at since the last crash, the market just continued to increase more and more. And then during COVID, I think we were both, you've got a lot more hair on your head than I do. I think I pulled mine all out, but we had so much volume going through. It was sort of craziness, and people are just making things happen. But today, deals are harder to create, and we've got more complex transactions occurring. But as far as somebody coming in and looking to do a transaction, what are the typical things that you want to know, Tom?
Well, first off, as you had mentioned, we want to know, why are they doing the deal? Do they need to do the deal? So that's where there's going to be a number of questions that we're going to ask them, because there's a big misconception about what even gain is in a transaction. And this is a tax-deferred exchange, so we're trying to defer gains on property transactions. But there's a big misconception about what gain actually is. And a lot of people just think that it's the cash they're walking away with. They don't have the information a lot of times themselves, either from their tax or legal people, to know whether or not they even have to do an exchange. We can, through a number of quick questions, figure out pretty quickly that, whether or not they do have gains on that particular transaction. It may make sense, but they also have to look at what else has gone on in their life for that year, and do they have other losses maybe that can offset gains. It's not always the right thing to do. The exchange is not always right for people, and we both handle transactions or phone calls all the time where they just don't need to do an exchange, and we don't have a problem in letting them know that. So a lot of times we'll take a phone call and they want to know what they're going to pay in taxes right away, and that's not an easy answer either. We might know after getting some information from them what their exposure might be if we're looking solely at this deal. But again, there's a lot more going on in their life than just this one real estate transaction. A lot of times they'll pop in and say, well, yeah, this property also is a property that I used to live in. And that brings up other questions. How long ago did you live in it? If it was recently, they may be able to take advantage of both the Section 121 and the 1031 tax codes. Take their universal exclusion on the property for the time that it was a residence, and for anything that they've got over that, if they've got over the $250,000 and $500,000 capital gain amounts, then they can do an exchange on the property and hopefully defer the balance.
So along those lines, we got a question. Actually, it looks like this morning from somebody that emailed in, just had a question regarding a conversion of a property from their primary residence into an investment. So the exact scenario you just mentioned. And they gave us some details, but they're wanting to know what they need to spend as a replacement. And really, if you look at the message, it talks about their gains and talks about 250 or 500, and then they're asking is the 500 what needs to be spent, or what do they have to spend going forward? But they didn't give us the value of the house or any of the closing costs or anything that was going on, right? I mean, so for us to answer what they have to spend in a transaction, I mean, you're really sort of stuck. I mean, so they're married, right? So they got a $500,000 exclusion. So whatever the thing sold for, I mean, how would that work?
Yeah. So, and it's great to at least get this much information going forward because now we know what questions to or where to start with our questioning back with them. But they if it's a married couple and it is a property that they had lived in, and they had lived in that property for 2 of the last 5 years. So really, they moved out of it 3 years ago or less. If that's the case, then they can take that exclusion, which means that they really could go down in value as far as the exchange is concerned by about $500,000 and still defer all their taxes because they can get the $500,000. If they sold a property that, let's say they sell a property for $1 million and it's got 800,000 in capital gains, then they could take the $500,000 exclusion and do an exchange on the remaining 500,000. So they buy a $500,000 property, and that's going to allow them to defer the balance of the 800 in capital gains.
So 121. I mean, if we look at 1031 and 121, the universal exclusion. And when we got in business, it didn't exist, right? So that was 1997. And I guess what I'd say is 1997, 250 and 500 in gain meant something. If you just look at what's happened in the last few years, just with inflation and the values, the 250 and 500 is woefully inadequate. It probably ought to be $1 million, $1.5 million, or $1 million or $2 million or something like that. But I mean, the 250 and 5 is woefully inadequate for people in today's world. But when you're looking at that stuff, 1031 is going to apply to what something is at the time of acquisition or disposition, where 121 just simply applies to any property that meets that 2 out of 5 occupancy.
Yeah, and just to be clear in what I was just going through, so again, that the property at the time that the sale occurred was a rental property, but it used to be the primary residence. And it was the whole property was the primary, but it's now all been rental property and within a time period that will allow for the Section 121 exclusion. We also deal with properties all the time that are mixed use properties that people can have an allocation for the primary residence portion and also the investment property portion. And that can be it might be a duplex, might be a fourplex, might be a ranch or farm property that the client's living on, and so they have to have the help of their tax and legal people to determine allocations for the investment portion and the primary residence portion. Bottom line, they can do both 1031 and 121, and again, hopefully they can defer all their taxes. But Section 1031 is certainly not an all or nothing proposal or transaction, and it's very common to have people that are either wanting to pull money out or the property that they're looking at as a replacement property is just not up to the same value as what the investment portion may be, and they'll it doesn't disallow the exchange. They still have a valid exchange, but they may have some tax on the difference if they're going down in value. In the industry, it's referred to as boot. And so boot occurs if they're getting something back in the transaction that is not real estate. If they go down in value, they're either going to have boot as a result of cash that they receive and they're not spending, or they're going to have boot in the form of debt relief because they've got a loan on the acquisition that is less than what they previously had. There's a lot of different ways that they can go about these transactions. A lot of different ways that the Section 121 and 1031 can be applied at the same time in property transactions. And you're absolutely right. For these numbers to stay for the last 27 years unchanged, 500,000 is not worth what it was then.
So it's funny, I don't even hear anyone talking about it. The politicians. Nobody talks about bumping those numbers, and it's really sort of intriguing to me. But so I just want to clarify. So you talk about relinquishing, let's say, an asset that could be a single asset with allocations, both investment and residence, right? So what about people? So I was on a flight home the other night, and I'm sitting next to a gal that the VRBOs her house. So she travels a lot. When she's gone, she's got that, but then she also VRBOs just a room in the thing all the time. So in that situation, you'd be looking at whatever portion of the house is being used in that context. And I mean, with depreciation or I mean, what do you do? And carving it up obviously gives you the ability to allocate things different ways.
Yeah, and that again is something that they're going to really have to look to their tax advisors, and hopefully the taxes have been treated uh, for several years or however long they've been doing this, where they've got the percentage allocated. The tax people have got the percentage allocated. They're taking depreciation on the property for that percentage, and it's very well documented. But yeah, that can certainly happen. It happens all the time. There's such a big, a lot of people with the ADUs now.
That's what I was just going to say.
Yep, happens all the time, and the dollar's not going where it used to go, and so people are looking for other income sources all over the place. Look at the number of people who are going back to work that thought they were retired, and if somebody has a room or a separate unit on their property, maybe they can rent that out and avoid having to go back into the workforce.
So if they're renting out a portion of their house or they got the ADU in the backyard, you just commented about depreciation. What's the government's position on depreciation?
Well, they feel that if you have property, if it is indeed investment property, rental property, it's depreciable. Whether or not you have taken that depreciation, they can treat it as though you have, and so you may end up with a lower basis and depreciation recapture that you didn't know that you really had. So
and never had the benefit of.
Yeah, never had the benefit. So if you can take it, it is a great benefit. If you can take depreciation, certainly do so.
I mean, they hear me a lot more, and on the presentations, I'll always say, look, good tax people, I think, are some of the most important people, period, in your life these days. And we'll talk a little bit later about some of the tax proposals in the Harris side, the 24-party platform, and what they're proposing. But if you look at these things, and if you think about, I was talking to a buddy this morning. And, Eric and I were talking about the need for good tax people and what's going on in these different situations. And you start thinking about just a question. I had a email yesterday I got from somebody he said, I looked at 24 different, I think it was like 24 different capital gains calculators. And he says, they're all giving me different answers. And I'm laughing because you just said it. You want a good tax person, period. But
Yeah.
if you look at your return on investment, you might, if people are interested about cost seg, take a look at our YouTube channel. There's a series of videos on cost seg. It's cost seg is just sort of the basic delineation of the investment property, right? And if a rental house, most people are going to say, okay, I bought it for X and so that's $250,000 purchase. Maybe the dirt's 100 and the improvements are 150, and you're going to write the 150 off over 27 and a half years. I just threw numbers at you, but who makes up those allocations, right? And that's an opportunity where you got to work with your tax people to do that. And the more you shove to the improvements, the better your return on investment's going to be. And I just don't think people think about that much. Cost seg is just that on steroids. Instead of two allocations, you're going to have 50 or whatever it might be. And we can look at our, one of those videos on cost seg that we've got online if you want to know more about that stuff. But who puts a value on the ADU? Who puts a value on the room? Who's helping you with that stuff? And I just see such an aversion. People don't want to pay for those answers. And think about your basis on a property. basis is simply the purchase price plus capital improvements minus depreciation. You better keep track of every receipt you've got for that property from the time you bought it or through your investment life, because in 1031, we've got a basis carry forward, right? 1033 involuntary conversions, basis carry forward. As you said earlier, 121, when it came in before that, we had 1034 basis, carry forward.
Yeah. And a lot of people will say, well, is my basis really going to be that important if I'm not going to ever sell it, if I just keep exchanging? And yeah, it is, because it's going to determine how much you're going to be able to depreciate on the acquisition of the new property, because your basis is carried from one property to the next, and it may be adjusted upward if you're going up in value. Certainly, go up in value by another 500 grand. You may have up to that much more depending on the property type, but you may have that much more to depreciate moving forward. And again, big benefit if you can. But yeah, those allocations are going to have to be something that's agreed to between tax, maybe legal. It's going to be determined a lot of times by brokers' help coming in and giving some comps in the market, and so there's a number of different things that are going to play into that equation. But it's certainly very important to figure out for the life of the investment.
So when you're looking at a basis in a property, like I said, it's that acquisition. Probably the acquisition varies dramatically depending on how you got the asset, and then your capital improvements. How often do you talk to somebody when you start talking to them about buying a property, whether they put money into it during the time they've owned it, whether it's been expensed or capitalized?
Well, almost every time we talk to them. Yeah, it's because people will say, I bought this property for X. I put Y into the property, and then it's basically the next question that comes out is, well, were those monies that you put into the property, were they capitalized improvements, or was it just expensed items? Were they major remodels, items, new kitchen, new surfaces, new siding, things like that, or was it a lot of repair? Because that's going to affect their basis, because they may think that they put 100 grand into property and that instantaneously bumps their basis by that much, and bottom line, maybe none of it does. If it was all expensed, then certainly it was a benefit to them in that tax year, but it's not going to affect their basis and therefore gain on the sale when that occurs.
So earlier you're talking about numbers a little bit, the basis, and you start looking at how people allocate things to improvements or capital improvements or just writing it off as expenses. And I think there's so much confusion. People you ask them, well, how much money do you put? Oh, I put 100 grand into it. Do you write any of it? Oh, I wrote it all off. Right. So in that context, that situation, there's no change in the basis, period. But that's where the good tax people, and also what happens sometimes, a capital improvement might just be an expense if it's part of a closing, right?
Yeah, could be. Yeah, if they're getting property ready to sell, and yeah, it's.
So what happens? How often do you talk to somebody that prepping a property? I laugh because our friend Chip he was complaining that they're selling their house, and that the broker listing for them, they want to do like $50,000 worth of work to it. And he's like, I got to come out of pocket all that money. And it's like, okay, so what happens for somebody that maybe took money off their HELOC, put the thing in, or maybe bought a property with a HELOC instead of going to get a loan? What's that HELOC look like on a disposition, and what happens with the exchange?
Yeah, so that's a good question.
HELOC, for those who don't know, is a home equity line of credit.
Yeah, so they borrowed money for the property acquisition, and they probably want to pay that back when they sell their property, but it's not a recorded lien on the property. It's probably a lien on their primary residence. So, as far as the banks are concerned, that property is a debt-free property, owned free and clear. You sell it for $500,000. It's all equity. Everything would, in an exchange transaction, less closing costs, of course, title escrow fees and commissions and things like that. All of the cash would come into the exchange, and they cannot take any of that money without having to pay taxes on it. So it's, it's certainly a conversation that if they want to pull money back out and pay back that loan, we've got some things that we can certainly discuss with them to help them out. But it again takes planning, and that's where we come back to questions and answers and having those conversations. It's really important. Somebody may contact us initially and tell us, yeah, they bought a property for $500,000. They've got, they borrowed $250,000, they got a $250,000 loan. They may say it's got a $250,000 loan on it, and we see settlement statements or the title report, and no, there's no recorded lien, there's no debt against the property, and it shows it's all cash coming out. And so that is, comes back to, having those really important conversations and getting down to the bottom of exactly what's going to take place when closing occurs.
So you probably agree with me after doing this for so long that when people ask us when we'd like to know about the transaction, I tell them when they buy the property, not when they're selling it. But because you and I were taught the same strategies with investments. What are you going to make? How are you going to make it? When are you going to make it? If you can't answer the questions, don't buy it. But with 1031 in mind, it's really that form of ownership is critical, right? If you and I go buy something together and we do it via a limited liability company, what do we own? And if we go to sell it going forward, are we going to go forward together? And what happens in that situation if we want to go separate directions?
That's a question that comes up all the time. Or whenever we see somebody come in and they've got a property that's held under an entity like a limited liability company, again, one of the first questions we're going to ask is, how many members are there? Who are the members? Does everybody want to go forward together, or do they want to split up and go their own separate ways? And yeah, we want to get the phone calls well ahead of them ever listing properties for sale if we can. It takes planning, especially in those cases where, you and I own property together in a company name, and you want to take your money and invest into something else. And maybe I want to take my money and I don't mind paying taxes. Maybe I've got losses that I can offset for that year, and I want to go on a vacation or something.
Maybe you just want to buy a boat.
Yeah, maybe I want to buy a boat. Yeah. And that a lot of times with these partnerships, people will initially start out with the same goals in mind, and they might go through several transactions, but they eventually always end up getting to a point where they want to go separate ways. And so that we see it all the time, and we don't want to see it, a week ahead of closing. But if that is a situation, they've got a partnership, partnerships and exchanges. We've done so many, you've done tons of videos on this stuff. We've got all kinds of articles that have been written. We send out information on partnerships and exchanges to potential clients all week long, every week. And it's a big question. It's a big deal. Super important to talk about because it takes planning. A lot of times these LLCs are going to have to be dissolved and switch it over to a tenant in common ownership. And sometimes that's done, a year or two in advance. It all depends on how conservative people want to be about it. But that's a very hot topic in the exchange world.
So Tom, is the deed or title of the property, does that always indicate true ownership of the property?
No. And we'll have people that will tell us that they either own property individually or they own it in a partnership, and we'll get a copy of the title report, and it doesn't reflect what they've been telling us. And they said, well, we deeded this property, we just never recorded it. but they have treated it tax-wise as one way or the other, a partnership or individually owned assets. And if that's the case, then great. It's a matter of getting that deed recorded, and hopefully they have been treating it tax-wise as however they ultimately think they have been. But if they've got a partnership and they say that no, we dissolved it years ago and it's not been treated that way, then it could have other issues.
So we got a deal last month, and this is, I think, a great example of having the conversations and why, we used to talk about the difference between in the exchange world, what we do is called, we're called QIs, qualified intermediaries. We're called facilitators, accommodators, and we always, just with our roots, thanks to Ron, we always called ourselves facilitators, taking an active role in transaction. But there are many people that just sort of take the paperwork and put it together and don't ask the questions. And a deal that comes to mind is one that came up last month that was actually put together by another company. I don't know how the other company, got involved, but they just put it together, and it was just in the gentleman's name, Oregon couple, and been married for years and filed jointly. So both have been enjoying the benefits and burdens of ownership, but they just set up the exchange in the gentleman's name because that's how the title read. And nobody bothered to ask them if that's the way they wanted to do it or if that was the way it had been handled through the years. And fortunately, their broker's the one that sent them to us, and we got involved in the transaction and actually had the deeds corrected to get the spouse on the name, on title as well before the disposition. And those changes were all being done. The set properties were being sold because he was terminally ill.
There's concerns over his health. Right?
Yeah, concerns about his health.
Yep.
And they were trying to get some planning done. And he actually, unfortunately, passed away a couple of weeks ago. Yeah. And so if she hadn't been added.
Yeah, mid-exchange.
Yes.
Right. Yep. Sale had occurred. Yeah. And thankfully she is on title, and so it certainly is going to be a great benefit to have that moving forward, because she does have to complete the exchange.
You want to talk about that a little bit? Because the way the law is today, you get stepped up basis. For now, take a look at the 24 policies, but at least today you got a stepped up basis. But real quickly,
she would for his portion of the property if they're both on title and he passes, then they'll establish what the fair market value is for the property currently at time of his passing, and now the basis will be adjusted accordingly to give it.
But they're still going to have to complete the exchange and meet the value and equity requirements they were looking at while he was alive. Otherwise they're going to have the tax.
Moving forward, the basis will change into the new property acquisition. But it's complicated, and again, it's a good thing that everybody did get involved with that the topics were brought up, that there was concern over his health, and you don't want to hide from this stuff.
So Tom, when we were much younger and we were getting into this business, one of our mentor Ron's statements was that keep your eye on the politicians, that they're going to come after us over and over again. And even though the code's over 100 years old at this point, final guidelines were issued fall of 91, right? Yeah. Right as we put the company together. Yep. We've had changes. We've had revisions on reverse exchanges. We got that. We got second home stuff. We lost personal property in Trump's tax reform in 2017. By the way, for everyone out there that thinks that all that his reform was for the wealthy, it took all the personal property away and shoved it into QOZs and all. So you used to be able to exchange. We had so much fun doing cars and boats and planes and stuff.
Yeah, we're both car guys. Yeah, those are fun to see what was coming through. That's.
All that went away.
Yeah.
So right now we're facing a situation yet again where they want to screw with 1031. I think last time when Biden was elected, in his early budget, they were wanting to cap annual deferrals you could keep 1031, but they wanted to cap it to $500,000 per person per year. The 24-party platform actually does away with 1031 and also does away with the long-term capital gains tax rate. So we'd have a tremendous, basically going from 20% on appreciation, 25% on depreciation at the top end, up to 37%, so it'd be normal income. We're looking at, so you combine that with elimination of 1031 and what's going to happen to market velocity. You've got the taxation of unrealized gains, which on Wall Street would do one thing, but imagine people owning homes or ranches, and would they even be able to keep the properties they've owned for years? And especially considering that a lot of the gains are subject to, like I said earlier, not appreciation per se, but inflationary gains, especially when you're looking at the 250 or 500, and then elimination of the stepped up basis. I would argue that any one of those things is really a doomsday situation for investors. But if we combine a few of those, it's catastrophic. And just can you imagine the sheer cost of implementing that taxation of unrealized gains? Is one thing on Wall Street where you've got a value of every stock at any given second. But what's real estate worth? I mean, our youngest brother, for those of you that don't know out there, he is an MAI appraiser. I mean, that's top of the heap in the commercial appraisal world. And I've asked him, if you watch our videos, you've heard me say before, it's like, hey, Greg, how do you know when you've done the right job? And it's like, well, it's easy. I said, what do you mean by that? Nobody's too happy or too mad, right? But those values are totally subjective. And could you imagine the sheer cost of trying to value those things?
Well, I guess, if you could look at it another way and say if they do pass all this stuff, then all the values of everything's going to plummet so much that nobody will have any gain. So, it's kind of, you laugh, but at the same time, it's gonna result in stagnation in the marketplace in all different fields of investments, real estate, stocks, everything. It's you mentioned we have had to fight this every couple of years, it seems, for quite some time. And, the politicians come out with these proposals and they think, well, these are going to be winners for us tax-wise. We'll get all these additional tax revenues. And it always turns out to be a loser. It always does. They think they're going to get taxes on every transaction. Well, you know what? Those transactions are just going to stop, because if somebody has to pay such a huge amount of their net value or net equity in these things, and maybe it's not even equity they have, but if they've got tax exposure on these transactions that are just through the roof every time, and they're not going to sell. If they don't have a way of deferring taxes, they're not going to move from property to property. They may do it one time, and then they're going to sit on them. And now what goes away, all the tax income, all the revenues on appraisals and inspections and escrow and real estate commissions. We look at settlement statements every day, and the number of different fees that are all taxable fees the government gets their cut on a settlement statement is tremendous. So if all that stuff goes away, so does the income.
For all those people,
yeah.
The tax revenue for all those people.
Yeah, all those people. So the private industry is hurting. The government is going to end up losing money on it. And again, our industry, the FEA, Federation of Exchange Accommodators, they've got we pay for a lot of people to do a little lobbying in Washington, and they are always coming out with all of these studies. These proposals always end up in big tax revenue losses for the government. It's the total opposite of what they expect. These people they've not been business people. They don't live in the real world, and they should be consulting with those that do. That's the bottom line. And they apparently always know more than we do. So, they're not going to.
They wrote a white paper on it, Tom. They went to Ivy League school. They wrote a white paper on it.
I don't remember anybody calling me ever and asking my opinion about stuff, or anybody that I know that would be a great source of information for them. So.
So the last time this was the proposal to cap the gains, ultimately leading to stagnation of the market, but ultimately the way that it was really fended off was to show. I mean, when was the last time that? Well, anytime you and I buy a property together, we're always improving them, right? But I mean, think about, for those of you out there, think about the last time you bought a property where you didn't put any money into it, right? So the vibrancy of the market, there's all these cries for low income housing in a market where the government hits you with all these SDCs, all these fees. It costs you so much to get a shovel in the ground per unit, where you can't afford, and now cost of building, the cost of the dirt, everything is so high. They want low income housing, and it's just, you can't build it in the current marketplace, at least up and down the West Coast. But you think about the buildings, those and the stuff that we liked, right? I mean, sort of the garbage real estate we'd buy and improve. Okay, so you take something, we can all drive down the street and we can see a property and know whether the owner wants it or not, right? So there's ways, if you're an investor and you want to buy a property that's sitting there rotting on the sidewalk, and if you just go ask the person to list it, you give them a place to go. Tell them, hey, go buy a Delaware Statutory Trust or something. Get the check in the mail, defer your gain, do that stuff. But really, the last time the proposals happened, we started looking at the industry, NAR. Thank you. You start looking at how 1031 was successfully defended at that point, was just that market velocity and what happens to low-income housing, which would be those BC apartments, not the big shiny new ones that the real estate investment trusts and everybody buys or builds, but it's the old stuff, right? And so if you can't, if it can't be sold, either because we have insurance issues now where insurers aren't insuring older buildings. So if you can't insure it, how's anyone going to buy it? But also just the vibrancy of those properties to keep them working. Every time somebody buys it, they're shoveling money into it.
Yep.
So it's really critical when you look at this stuff. Understand, really educate yourself. Our father always used to say, anytime you read anything about something you know something about, you know how wrong it is. So I would challenge everybody out there, really take a serious look, whatever side you're on, or I think more of us are probably in the middle, just tired of all the politicians. But if you're looking at this stuff, really take the time to understand what candidates are trying to do what, and what the ultimate impacts are. Don't just listen to the talking heads and believe them. Really think about it, rationalize what's going on, and what do you think the impacts of these different measures are going to be. And obviously for the two guys sitting here today, I mean, we look at, and we're sort of unique, honestly, because we also have, we're talking to you today from the context of a 1031 side via equity advantage. If you've got retirement money and you want to take that money to go out and buy things Wall Street doesn't sell, give us a call. IRA Advantage is going to take care of that. And when they were talking about taxing unrealized gains, I started thinking, it's like, okay, well, and if somebody comes to us on IRA Advantage side, how often have we had some advisor say, well, gee, you shouldn't take your IRA 401k and go buy real estate because you lose long-term capital gains tax consequently, you lose depreciation of those different things. But I would argue if some of this stuff goes through, the only way you could afford to own real estate is maybe with an IRA or a 401k.
Yeah, there's a lot of different ways you can make money, but if you're making money, the government's going to want to take it. So you got to, like you say, pay attention to these proposals and who's proposing what, and make your own informed decisions.
Do searches with different search engines and clear your cookies so you're not getting your new search contaminated by the old search and everything else. But really, ask the questions. The only dumb question is the one you don't ask. So really take advantage of the resources you got. It's endless out there today. But Tom, it was a lot of fun to sit here with you today. And if anyone's got questions that they'd like addressed, please reach out to Seymour at 1031exchange.com with your questions. We're happy to address them either directly via the phone or direct if it's something that we think is going to be of value for the greater good for all out there. We're going to do something like we've done today. I had a lot of fun with you today, bro. It's been too long, and I'm a blessed guy. I got my brother sitting next to me. I got my daughter sitting there filming and taking care of the audio for us. So it's family fun.
Yeah. Yep. No, got a great staff in here, and give us a call. We really would appreciate the opportunity to go through transactions with you, ask questions that are relevant questions, because they do need to be asked. And you know, if you don't need to do a transaction, we'll let you know, or from our perspective anyway here. It's just super important to talk about these things before you act.
Thank you, everyone. Look forward to talking soon, and enjoy this wonderful life. Thank you.
Thank you.
Bye-bye.